Welcome to Breaking News to Trading Moves. Today we're looking at a major corporate action in the industrial sector. It's a deal that gives us a really clear map of how one M&A transaction can affect a whole range of companies.
That's right. The headline we're focused on involves Sealed Air, and their ticker is SEE. They've just agreed to be acquired by the private equity firm CD&R.
And this isn't a small deal.
No, not at all. It's an all-cash transaction valued at $10.3 billion. A very substantial deal for this space.
$10.3 billion. So what does that mean for the people who actually own the stock right now, the public shareholders?
Okay, so the specifics are key here. Shareholders of SEE will get $42.15 for each share they'd own.
$42.15 in cash. And how does that price stack up against where the stock was trading before all of this?
It's a clear premium. It's a nice bump up from where the stock was before the rumors of a sale really started circulating in the market. So for investors, that's a very tangible gain.
And then after the deal closes, SEE is no longer a public company.
Exactly. It'll delist from the exchange and become a private entity owned by CD&R. And that change in status from public to private has its own set of consequences for everyone else in the industry.
Right, because this one action doesn't happen in a vacuum. You've got implications for other packaging manufacturers, for their big customers in the food industry, and even for the big asset management firms.
It really does. So our job today is to map that out. We're going to identify the groups that are positioned as the immediate beneficiaries, and then look at the ones who now have to deal with, new competitive pressures or different cost structures.
Okay, sounds good. Let's start with the most straightforward part. Who gets the money first? The immediate winners.
Yeah.
That would be the shareholders and, I assume, the advisors who put the deal together.
Yes, the most direct beneficiaries are, without a doubt, the existing shareholders of Sealed Air. For them, it's simple. They get cash at $42.15 a share. It takes their stock and turns it into a locked-in value.
You mentioned the premium. Why is getting this price right now so important for those shareholders? What's the context here?
Well, the context is that SE has been through a bit of a tough patch. They were dealing with some, let's call them operational headwinds.
Like what, specifically?
Things like rising costs for their raw materials, some supply chain problems still lingering from the post-pandemic period, and, the market was watching their capital spending plans very closely.
So the stock price probably reflected that uncertainty.
It did. The stock was trading at a lower multiple because of those concerns. So for a shareholder who rode through that volatility, this all-cash offer at a premium is a really clean, very favorable way to exit. It basically just wipes away all that recent operational noise with a guaranteed return.
A good outcome for them. Now, what about the people who made the deal happen? The advisory firm for Sealed Air was EVR. For a firm like that, a $10 billion deal must be a huge win.
Oh, absolutely. For an independent advisory firm like EVR, these large-scale deals are, they're bread and butter. This is their highest margin work.
Because it's not just a simple transaction.
Right.
There's a ton of complexity.
A massive amount. You have to value the company correctly. You have to manage all the due diligence, navigate all the regulatory approvals, coordinate with the buyer, in this case, a very sophisticated private equity firm, and make sure the final deal is structured to protect the sellers. That's thousands of hours of very specialized labor.
And financially, what does a $10.3 billion transaction mean for EVR's bottom line? The fees must be substantial.
They are. We don't see the exact numbers, of course, but for a deal this size, the advisory fees are typically in the high 7, maybe even 8-figure range. That's a huge injection of revenue for a firm like EVR.
So it's more than just the money from this one deal.
It is. It's also a major validation of their business model. It proves they can handle these huge, complex industrial buyouts, often competing against the much larger bulge bracket banks. A public success like this is the best marketing they could ask for. It helps them win the next big deal.
Okay, so a clean exit for shareholders and a big payday plus prestige for the advisors. Let's widen the lens now and look at the rest of the packaging sector. When a leader like SEE gets bought out at a premium, it makes everyone reevaluate the other players, doesn't it?
It does. This is what we're looking at here, this idea of a market read across or a re-rating story. Investors immediately start looking at SEE's peers and wondering if they're undervalued too.
Why, though? Why does a private equity firm paying up for SEE make investors think a more, say, general packaging company is suddenly worth more?
It comes down to precedent and validation. CD&R isn't just any investor. They're a top-tier private equity firm.
Huh.
When they put $10 billion on the table, they're making a very strong statement about the entire packaging industry's future.
A statement about its growth, its stability.
Exactly. They're signaling that they believe in the long-term growth, the defensive nature of the industry, and the resilience of its cash flows, even if the broader economy looks a bit shaky. So investors take the price paid for SEE and use it as a new benchmark for the whole sector.
Okay, so let's use a specific example. How does this affect a company like Packaging Corporation of America, ticker PKG? They're a huge player.
PPG is a perfect case study. They benefit from this re-rating, but they're a slightly different business than SEE. PKG is very focused on containerboard and corrugated packaging cardboard boxes, essentially. It's a more cyclical part of the industry.
Right, less specialized than SEE's protective films and things like that. So why does the logic apply?
Because PKG has the one thing private equity firms value most in these kinds of deals: solid, predictable cash flows.
And why is cash flow the magic ingredient here?
Because these are leveraged buyouts, or LBOs. The whole model relies on using the target company's own cash flow to pay off the debt that was used to buy it. PKG is a cash machine. It's been generating reliable cash for years.
So investors look at PKG and think, well, if SEE is worth this much and PKG has these amazing cash flows, maybe it could support a similar kind of deal.
That's the thought process exactly. They start to see PKG as a potential future target itself, or at the very least, they start applying a higher valuation multiple to its earnings based on the new precedent set by the SEE deal.
Let me push back on that a little, though. SEE has a lot of proprietary technology, things like their shrink wrap and food sealing systems. PKG is, like you said, more in the commodity containerboard business. Is it really fair for the market to apply the same premium logic?
That's a fair challenge, and you're right. SEE's specialized products do command higher margins. But the market's justification has a few layers. First, PKG is seen as a best-in-class operator in its own segment. Second, private equity firms like having a mix. Sometimes they want a stable, cash-generative asset like PKG to balance out other investments.
And the third layer.
Most importantly, the SEE deal validates the end market. The demand for packaged goods, whether it's food or e-commerce, is strong and stable. Since PKG serves that same resilient end market, its value goes up by association.
Okay, that makes sense. Let's look at another one. Amcor PLC, ticker AMCR. They're different from PKG again.
Right. AMCR is a really good contrast because they're a massive global player, not just North American. And their product, mixed flexible and rigid plastics, films, containers, is actually much closer to what SEE does than PKG's corrugated boxes are.
So for AMCR, the comparison is even more direct.
It is. The re-rating story applies to them for the same cash flow reasons. They're perfectly suited for an LBO structure, but there's an added element. With SEE leaving the public market, investors who want exposure to that specialized, high-margin end of the packaging world now have one less place to go.
And AMCR becomes one of the main remaining options.
It becomes the primary remaining public specialist, in many ways. So the expectation of more M&A in this space, plus its new status as the go-to stock for that segment, both help support a better valuation for AMCR.
It's clear the deal lifts valuations for a lot of the peers. Let's pivot now to the money behind the deal itself. A $10 billion leveraged buyout needs a lot of financing. So let's look at the boost this gives to the big alternative asset managers.
Yes, this is where we move beyond the packaging industry and look at the health of the financial system. The fact that CD&R could pull off a deal of this size is seen as a very positive indicator for the financing markets as a whole. And that's great news for the big listed private equity firms.
You mean firms like Blackstone and KKR?
Exactly. Blackstone, ticker BX, and KKR, ticker KKR.
Why is the $10 billion number so important? Smaller deals get done all the time.
They do, but a deal of this magnitude requires a whole different level of financial machinery. It proves that the big banks are confident enough to underwrite the large amount of debt required, and it also proves that there are plenty of buyers for that debt like pension funds and insurance companies.
So it's a litmus test for the health of the LBO debt market.
It's a perfect litmus test. It confirms that the market for large-scale leveraged debt is open and functioning well. And for firms like Blackstone, that is absolutely critical.
Let's focus on Blackstone, BX, for a second. How does a packaging deal done by a competitor actually help their business?
Because Blackstone's entire business model depends on being able to put their massive buyout funds to work. They make money in two main ways: management fees on the capital they manage and then performance fees, or carry, when they successfully sell an investment for a profit.
And they can't earn those big performance fees if their money is just sitting on the sidelines.
Precisely. They have to deploy that capital. The SEE deal is a giant data point that tells them the conditions are right for deployment. The debt is available, the pricing is stable. It gives them the green light to go after their own big deals, which gets their fee-generating engine running at full speed.
So it's about confidence in the market's ability to support their strategy. Is it the same story for KKR?
It's the exact same fundamental principle. KKR is also a huge beneficiary when the market signals this kind of health. They're known for doing very large, often complex global buyouts. Seeing a $10 billion deal get financed smoothly reduces the perceived risk for their own deal pipeline.
Which means they can be more aggressive in putting their own funds to work, driving their own fee income.
That's it. It improves their opportunities to execute their own strategy, which is ultimately what drives returns for their shareholders.
Okay, we've got a pretty solid list of the winners. Now we have to look at the other side. A deal this big also creates challenges for other companies. Let's start with the direct competitors, the mid-tier packaging rivals.
This is a really important consequence. The move from SEE being a public company to being a private one, backed by CD&R, is a fundamental change in the competitive landscape.
How so? What changes on day one?
The biggest change is the investment horizon. A public SEE had to answer to Wall Street every 90 days. They were judged on their quarterly earnings. A private SEE, backed by a PE firm, typically has a 5 to 7 year plan. They don't care about short-term earnings dips.
And that frees them up to make long-term investments.
It frees them up completely. Think about a major project, like a huge factory automation upgrade. For a public company, that might depress earnings for 2 years before you see the payoff. Investors would likely punish the stock for that.
But a private SEE can just go for it.
They can greenlight those big investments in technology, in R&D for higher value products, all without having to worry about a quarterly conference call. The goal is to build a much more efficient, more valuable company in 5 years, not to beat an earnings estimate next quarter.
And that puts a company like Sunoco Products, ticker SON, in a tough spot.
A very tough spot. SON competes with SEE in several areas. They are now facing a competitor that is about to take a big leap forward in efficiency and product quality. SON now has to try and keep pace with that investment just to hold on to its market share.
The same logic would apply to graphic packaging holding company GPK then.
GPK is in a similar position, yes. Even though their focus is on paperboard, the overall pressure to automate and become more efficient is industry-wide. And this leads to what's known as margin risk for both SON and GPK.
Break that down for us. What exactly is the margin squeeze they're facing?
Okay, so if they're forced to ramp up their own capital spending just to keep up with the new, more aggressive SEE, that money has to come from somewhere. It means higher costs, maybe taking on more debt.
And they probably can't just raise their prices to cover those new costs, can they?
Not when their main competitor is getting more efficient. So they have to spend more money on new equipment and R&D, but they can't charge more for their products. Their operating margins, the profit they make from their core business, gets squeezed from both sides. They're spending more just to stand still, and that directly hurts their profitability.
That's a clear challenge for the competitors. What about further down the supply chain? Let's talk about SEE's customers, like the big food producers.
Right. This is another group that faces a new kind of risk. Many large food companies rely heavily on the very specialized, often proprietary packaging that SEE makes.
This isn't just a standard cardboard box we're talking about?
No, not at all. This is advanced stuff. Things like vacuum seals for meat, modified atmosphere packaging that extends shelf life, special moisture barriers. It's critical for food safety and preventing spoilage.
So for a big food company, switching suppliers isn't easy. Let's take Tyson Foods, ticker TSN.
TSN is a perfect example. As one of the world's largest protein producers, they use immense amounts of this kind of specialized packaging. A newly private, PE-backed SEE is going to be laser-focused on efficiency and maximizing its own profit margins.
Which means they might have more power to raise prices.
They will. If SEE invests in new technology and creates, say, a new film that extends the shelf life of fresh beef by an extra 2 days, that's incredibly valuable to TSN.
And SEE can charge a premium for that valuable innovation.
They can, and they will. TSN needs that packaging to run its business. The cost of product spoilage is far greater than the slightly higher cost of the packaging. So SEE gains a lot of pricing power.
And this would apply to Hormel Foods, HRL as well, for their products.
Yes, HRL is in the same position with their processed meats and other shelf-stable products, and for both of these companies, this pressure on packaging costs is coming at a difficult time.
Why is that?
Because they're already struggling with volatile commodity prices. The cost of meat, grain, animal feed, that's all been very unpredictable. Now they're facing potentially higher and stickier costs from a key supplier on the other end.
So they're getting squeezed from both sides, raw materials and packaging.
Exactly. And unlike commodity prices, which go up and down, a price increase from a powerful supplier like the new SEE is likely to stick. It's very hard for them to pass that cost on to consumers in a competitive grocery aisle, so they often have to absorb it, which again hurts their own margins.
Okay, so we've covered the competitors and the customers. What's the final group that's negatively affected by this deal? You mentioned the containerboard heavyweights.
Yes, this is more of a structural market effect that happens when a company like SEE gets taken private. It changes the composition of the publicly traded industrial packaging sector.
What do you mean by that?
Well, SEE was seen as a more defensive, specialized company because a lot of its business serves recession-resilient markets like food and healthcare. Once it's gone from the public market, the investors who want exposure to packaging are left with a different set of choices.
We're left with the more cyclical companies.
Primarily, yes. They're left with companies that are much more tied to the swings of the global economy, like industrial production and e-commerce shipping volumes.
So a company like International Paper, ticker IA, becomes a much more dominant benchmark for the sector.
It does. IAP, which is a massive player in cyclical paper and containerboard, now represents a much larger piece of the public packaging pie. With SEE gone, the overall defensive quality of the sector available to public investors goes down.
And the same would be true for another big player like Smurfit Kappa, SW.
Correct. Both IP and SW now disproportionately represent that more cyclical side of the industry. For some investors, that risk profile is less attractive than the blended portfolio they had when SEE was part of it.
And this is what leads to the idea of capital rotation. The money that was invested in SEE has to go somewhere else now.
That's the key question. A lot of institutional funds have mandates to invest a certain amount in, say, packaging and materials. With the best defensive name in that group gone, a fund manager might decide that the remaining cyclical names like IP and SW don't fit their risk requirements anymore.
So they sell them. And where does that capital go instead?
There are two very likely destinations. One is short-term. Some of it will just buy SEE stock and wait for the deal to close to capture that last little bit of spread between the market price and the 42.15 offer.
A near guaranteed low-risk return.
Exactly. The other more structural destination is the alternative asset managers we talked about earlier, BX and KKR. If an investor is now less excited about the operational risk of the packaging companies themselves, they might decide to invest in the firms that are financing all the M&A activity instead.
And the net result of all that rotation is negative for IP and SW.
In the near term, it can be. You have a large pool of capital that is now flowing out of those stocks. That selling pressure can cause them to underperform the broader market as investors reposition their portfolios in response to SEE's exit.
We've really covered all the angles here. We've seen how this one acquisition of SEE creates a clear set of winners. Its shareholders, the advisors at EVR, peers like PKG and AMCR, and the big financiers, BX and KKR.
And we've also mapped out the groups that are facing new challenges. The competitors like SON and GPK with the margin pressure, the customers like TSN and HRL facing input cost risk, and finally the big containerboard players like IP and SW dealing with that capital rotation.
So it's a very complete picture.
I think so. You know, the market's first reaction is always about the price, the premium being paid. But the longer-term consideration here is really about the competitive dynamic that's been created. You have a major player, SEE, that's now armed with a ton of private capital and a mandate to invest for the long haul.
And its competitors have to respond.
They have to. The real question is how quickly they can adapt their own spending and technology plans to keep from getting left behind. That operational response over the next few years will be the most lasting outcome of this entire transaction.
And on that note, just a reminder to everyone listening, the content presented here is purely the opinion of the author based on the material we've gone over. This is not financial advice, and it is not a recommendation to buy or sell any of the securities we've mentioned. That includes SEE, EVR, PKG, AMCR, BX, KKR, SON, GPK, TSN, HRL, IP, or SW. Please always be sure to conduct your own thorough research before you make any investment decisions.